The bull case. The primary driver of the bullish thesis for Frontline is an imbalance between the demand for seaborne crude oil transportation and the available supply of compliant, modern tonnage. For several years, the industry has operated under the shadow of a historically low order book, a trend that has finally culminated in a severe capacity crunch in 2026. As of late 2025 and early 2026, the global tanker order book as a percentage of the total fleet remains at multi-decade lows, hovering around 18% for crude tankers and 19% for product tankers. This supply-side rigidity is the result of years of capital discipline, uncertainty regarding future propulsion technologies, and limited shipyard capacity, which is currently dominated by container ship and LNG carrier orders.
While supply remains constrained, the demand for crude oil transportation has proved remarkably resilient. Despite long-term decarbonization narratives, global oil demand is forecast to reach approximately 104.87 million barrels per day in 2026. Although growth forecasts have been tempered by recent economic headwinds, the structural demand for the long-haul movement of oil is increasing. This is driven largely by the geographical decoupling of production and refining capacity. Production growth is increasingly concentrated in the Atlantic Basin, notably the United States, Brazil, and Guyana, while refining capacity expansions are centered in the Asia-Pacific region, specifically China and India. The tightening of the supply-demand balance is most visible in the fleet utilization metrics. VLCC utilization is expected to climb to 92% in 2026, the highest level since the pre-pandemic peak of 2019. In such a high utilization environment, even minor disruptions can lead to exponential increases in freight rates as the marginal cost of the next available vessel spikes. Frontline, with its massive exposure to the spot market, is uniquely positioned to capture this volatility.
Geopolitical tailwinds. The most transformative force in the 2026 tanker market is the radical reconfiguration of global trade routes necessitated by geopolitical conflict. The ton-mile metric, which measures the volume of cargo multiplied by the distance traveled, has surged to record highs as traditional, shorter routes are abandoned in favor of longer, more complex journeys. The escalation of conflict in the Middle East reached a critical juncture on February 28, 2026, with the effective closure of the Strait of Hormuz to non-Iranian-linked vessels. This choke point, which historically accounts for roughly 20% of global oil supply and 38% of seaborne crude trade, has seen its flows drop to a trickle, less than 10% of pre-war levels. The impact on the tanker market is twofold. First, a massive volume of oil, approximately 15 million barrels per day, is temporarily lost or must be diverted. And second, a significant portion of the global fleet is marooned or unwilling to enter the region due to safety and insurance constraints.
The redirection of Russian crude oil following Western sanctions has already added significant distance to global voyages, as Baltic and Black Sea barrels that once went to Europe now travel to India and China. By 2026, these sanctions-driven inefficiencies have become a permanent feature of the market. The subsequent Hormuz crisis has only amplified this effect. When ships are forced to bypass the Suez Canal or the Strait of Hormuz, the effective supply of the global fleet is reduced by the additional time required for each voyage. In this environment, Frontline's VLCCs, which are optimized for ultra-long-haul routes, command a massive premium. Furthermore, the shadow fleet, comprised of older, often poorly insured vessels carrying sanctioned oil, is facing its first major structural collapse. The transition of Venezuelan crude back to non-sanctioned commercial vessels and the increased scrutiny on Russian trade have begun to sideline these overaged tankers. As the pool of compliant tankers shrinks and the demand for long-haul transport rises, Frontline's modern, high-spec fleet becomes the preferred choice for major oil companies and traders who cannot risk the legal or operational pitfalls of the shadow market.
Frontline's strategic fleet renewal and technological advantage. Frontline has moved decisively to capitalize on the current market cycle by executing a multi-billion-dollar fleet renewal program. The company's strategy is built on the premise that in a high-rate environment, the most modern, fuel-efficient vessels will generate the highest margins and attract the most lucrative charters. In January 2026, Frontline finalized the sale of 8 of its oldest first-generation Eco VLCCs built between 2015 and 2016 for a total of $831.5 million. This transaction allows the company to harvest capital gains at the peak of the second-hand vessel market, where values for 10-year-old units have increased by over 20% in the last year alone, while simultaneously reducing the average age of the fleet. Following this sale and the parallel acquisition of 9 latest-generation scrubber-fitted Eco VLCC newbuildings for $1.224 billion, Frontline's fleet is among the youngest and most efficient in the world.
The strategic inclusion of scrubbers, exhaust gas cleaning systems, on 57% of the total fleet and 100% of the newly acquired VLCCs is a significant competitive differentiator. Scrubbers allow Frontline to burn high-sulfur fuel oil, HSFO, which is significantly cheaper than the very low-sulfur fuel oil, VLSFO, required by non-scrubber vessels. In March 2026, as global bunker prices surged by 30–35% tracking the crude oil spike, the scrubber spread, the difference in price between HSFO and VLSFO, widened dramatically. For a VLCC consuming 50 tons of fuel per day, a spread of $150 per ton translates to an additional $7,500 per day in pure profit compared to non-scrubber peers. This technological moat is complemented by the company's compliance with tightening environmental regulations. As the IMO's Carbon Intensity Indicator, CII, and Energy Efficiency Existing Ship Index, EEXI, become more stringent in 2026, older vessels will be forced to slow down or undergo expensive retrofits to maintain their standards. Frontline's eco-fleet already meets these high standards, ensuring it can operate at optimal speeds and maintain its A or B ratings, which are increasingly required by ESG-conscious charterers and sustainability-linked financing instruments.
Robust financial performance and dividend potential. The culmination of the bullish case is found in Frontline's exceptional financial performance and its commitment to returning capital to shareholders. The company's fourth quarter 2025 results provided a glimpse into the cash generation power of the platform, with a net profit of $227.9 million and an adjusted EPS of $1.03. Even more impressive is the forward guidance for the first quarter of 2026. As of February 27, 2026, Frontline had booked 92% of its available VLCC days for Q1 at a staggering average of $107,100 per day. To put this in perspective, the company's average cash break-even rate for its VLCCs is only $25,000 per day. Every dollar earned above this break-even point flows directly to free cash flow. Frontline's management has modeled a base case cash generation potential of $2.8 billion for the next 12 months, which equates to $12.51 per share. At a recent share price of approximately $36.60, this implies a potential cash flow yield of 34%. Given the company's history of paying out nearly 100% of adjusted net income as dividends, exemplified by the $1.03 per share dividend declared for Q4 2025, investors are looking at the possibility of double-digit yields sustained through the duration of this market spike.
The company's balance sheet is equally robust, with $705 million in liquidity as of year-end 2025. The sale of older vessels in Q1 2026 is expected to generate an additional $477 million in net cash proceeds, which will comfortably fund the 25% down payments required for the 9 VLCC newbuildings delivering in late 2026 and 2027. This financial flexibility allows Frontline to remain aggressive in its fleet renewal while maintaining its spot returns proposition to investors. The bear case. While the bull case relies heavily on geopolitical friction, the primary risk to the Frontline investment thesis is a sudden de-escalation of conflict in the Middle East or Eastern Europe. Tanker rates are notoriously sensitive to sentiment. The current spike to $400,000 to $700,000 per day for VLCCs is a war zone phenomenon driven by insurance unavailability and extreme risk aversion.
If a ceasefire were to be reached, or if international maritime escorts were to successfully reopen the Strait of Hormuz, the scarcity premium would likely vanish overnight. Between 40 and 80 VLCCs currently stuck or waiting outside the Persian Gulf would suddenly become available for loading, creating a localized supply glut. The market has seen this pattern before.
extreme spikes followed by vertical drops, as the trade patterns normalize and the ton-mile demand shrinks back to pre-crisis levels. Furthermore, a geopolitical rapprochement, particularly one involving the reintegration of Russia or Iran into the global financial system, would be fundamentally bearish for the compliant tanker market. If sanctions were lifted, the 145 VLCCs currently over 20 years old that are serving the shadow fleet would seek to compete for mainstream cargoes, or at the very least, would stop acting as a floor for market supply. The sudden re-legalization of this older tonnage would provide a massive influx of capacity that could suppress rates for years.
Macroeconomic headwinds and demand destruction. The second major pillar of the bear case is the risk of a global economic slowdown triggered by high energy prices. In March 2026, Brent crude soared toward $120 per barrel following the Hormuz disruption. At these price levels, the risk of demand destruction becomes acute. The IEA has already begun to lower its 2026 global oil demand outlook. In February, the agency cut its growth forecast by 83,000 barrels per day, and in March, it further reduced the 2026 demand growth estimate by 210,000 barrels per day to just 640,000 BPD. Widespread flight cancellations in the Middle East and industrial disruptions in Europe are contributing to a precarious outlook for the global economy. If the world enters a recession, the demand for oil will fall, regardless of trade route length. For a company like Frontline, which is geared toward high-volume, long-haul crude trade, a slowdown in refinery throughput in China, which accounts for over 11 MBPD of imports, would be devastating. Any reduction in the absolute volume of oil on the water would directly impact vessel utilization, which is the primary driver of freight rate strength.
Fleet overcapacity and the 2027 supply wall. Although the current supply situation is tight, the bear case highlights a significant wave of new tanker deliveries scheduled for late 2026 and 2027. After years of minimal ordering, the bullish ton-mile market of 2024 and 2025 triggered a surge in new-build contracts. BIMCO and other analysts predict that crude tanker supply will grow by 4% in 2027 as shipyards finally deliver the massive orders placed during the 2024 peak. For the VLCC segment specifically, some forecasts suggest that as many as 70 new buildings could enter the market in 2027, which comfortably outpaces the number of vessels reaching the 20-year age threshold. If this supply influx coincides with a geopolitical de-escalation or a demand slowdown, the tanker market could face a triple whammy of lower demand, shorter routes, and more ships. For Frontline, which is currently paying premium prices for its own 9 VLCC newbuildings, $136 million per vessel, the risk is that these ships will be delivered into a much weaker market, leading to asset value depreciation and lower than projected earnings.
Regulatory compliance costs and financial leverage. The final segment of the bear case concerns the operational and financial pressures of the new regulatory environment and the company's capital structure. While Frontline's fleet is modern, it is not immune to the rising costs of carbon compliance. The Carbon Intensity Indicator, CII, is no longer a mere compliance check. It is a financial variable that influences vessel employment and financing. Vessels with persistent D or E ratings face reduced buyer appetite and pressure on valuation. Maintaining a top-tier rating through 2026 and 2030 will require ongoing investment in energy-saving technologies, hull coatings, and potentially the use of expensive biofuels. For owners of fossil fuel-dependent tankers, these exorbitant carbon reduction fees could eventually exceed the original new-building cost of the ship over its lifetime. Furthermore, Frontline's financial profile has some specific vulnerabilities. Analysts have noted that the company's trailing at margin, 19.2%, is below the previous year's 24.2%, and that its interest payments are not well covered by earnings. The company's high dividend yield is also described as not well covered, suggesting that the current payout policy is highly aggressive and leaves little room for capital expenditure if freight rates soften.
Additionally, Frontline's capital structure includes significant senior secured credit facilities and term loans. In an environment where interest rates remain high and inflation is stickier than expected, the company's finance expenses, $233.2 million in 2025, will continue to be a drag on profitability. The heavy reliance on short-term spot rates to cover long-term debt and dividend obligations creates a fragile balance that could be upended by any of the macro shocks discussed above. Conclusion. The investment case for Frontline plc in 2026 is a study in high-alpha cyclical exposure. The company has positioned itself to be the primary beneficiary of a perfect storm in the energy markets, a decade of underinvestment in supply, a geopolitical crisis that has shattered traditional trade efficiency, and a regulatory regime that favors its modern eco-spec fleet.
The bull case is powerful and data-driven, with 92% of its VLCC days for Q1 2026 already locked in at over $107,100 per day, more than 4 times the cash break-even. Frontline is essentially printing cash in the immediate term. The company's strategic fleet renewal allows it to harvest record asset values while positioning itself for a future where only the most efficient ships will be allowed to trade. For investors seeking high income and direct leverage to energy volatility, Frontline remains a premier vehicle. The bear case, however, provides a sobering counter-narrative. The current freight rate environment is unprecedented and potentially unsustainable. The risk of demand destruction from $120 oil, the potential for a sudden geopolitical de-escalation, and the looming wall of new tanker deliveries in 2027 all suggest that the market may be nearing a cyclical peak. Furthermore, Frontline's aggressive dividend policy and high financial leverage mean that any significant drop in rates will be felt acutely in the share price and the payout capacity. As the market enters the second half of the year, the focus will shift towards the 2027 supply outlook and the persistence of the Hormuz disruption. Investors should view Frontline as a spot returns machine that requires active monitoring of global trade flows and refinery throughput. The 100% payout ratio and high debt to equity mandate a cautious approach for long-term buy and hold portfolios. The 2026 tanker market is a high-stakes arena, and the history of the shipping industry suggests that the tides can turn with remarkable speed.